What I would say is if you're thinking about making a career change, don't. Until you have the stability to live for a year and a half to 2 years without a dime coming in, don't quit. And this is not to keep people out of the space. It's to make sure you don't go broke. You've got to make sure that you have the discipline covered. Don't quit till you can sustain.
Welcome, everyone, to the Road Less Traveled Show. This is a show about people that were successful in a previous career and left that career to go down a different path. I'm your co-host, Richard Coyne.
And I'm your co-host, Bill Zahller.
On today's show, we're so pleased to have David McIlwaine with us. David, welcome. Thanks for joining.
Thank you guys for having me. I'm really excited to be sharing my story with you guys.
Yeah, thank you, David, again, for being on the Road Less Traveled Show. Well, to start with, can you tell our audience a little bit about your background, what your first career was, and how long you're in that line of work?
My first career was advertising. I actually have a degree in advertising and spent 20 years following my college degree, which is like super rare. My world was I was selling media for a division of Viacom. Mm-hmm. And over the course of 2 years, when I was in my early 40s, I lost 2 jobs in 24 months. Because of corporate mergers and layoffs and shrinkage. Mm-hmm. And after running a region from Detroit to the Pacific Ocean and living on an airplane every day, the same thing happened to me twice. Mm-hmm. Yeah, and I see that everyone's shaking their heads. You guys might not be able to see this on radio, but Bill's nodding, Richard's nodding. We've all been there, right? And I realized I'd seen this story before. So I left my high-paying sales career. And at the same time, my marriage was on the rocks, obviously, for some issues with travel and being gone and prioritizing employment and money over family. And I came into real estate. So really, I've got a long background in corporate sales. My last job in corporate America was as chief revenue officer for a tech startup. In that deal, we had literally finished a Series B fundraising. I came in the next day to add 35 sales reps to my territory. And the CEO said to me, "Hey, guess what? We paid off our debt." I said, "What debt?" And they said, "Our debt." And it ate up almost all the Series B fundraising. And a week later, I was laid off. I had reversed negative growth for 5 quarters. Didn't matter. And the job before that, I'd been there 17 years and we got bought by our competition. And 6 months later, after hitting, I don't know, the 9th or 10th consecutive quarter of budget prior to the start of the quarter, I was laid off the day I hit the upcoming budget's quarter. So I learned real quickly that corporate America ain't going to take care of me. And, it's interesting. I had watched my father go through this at the same time frame when I was growing up. And I thought maybe this was just a transition from the 80s to the 2000s. But lo and behold, it really wasn't a transition. It was a generational shift in the way our world works. And no longer is there a relationship between the employer and the employee that is for life. Right. It is a transactional relationship. And I decided that I had too much money, too much self-worth, too much self-construct labeled into who I was working for as opposed to what I was living for. And I made a decision to never trust my family's wealth, my wealth, and the ability to keep a roof over my family to just one company. And that's how I got into real estate. Mm-hmm. That's kind of an executive summary of it. Everybody has their Toomey briefcase and their Toomey suitcase, and they've got their up in the air standard of cards. And I had all that stuff. And I really don't mind traveling, but I really did not like traveling 39 weeks a year.
Yeah. That's a lot.
Absolutely.
That's a lot.
Yeah. Like I said, hard a lot of things for sure. Yeah. What, so as you transition to real estate, what part of real estate did you go into?
Well, I started out, I was going through a divorce and I became a single dad. So I couldn't live on the road. And in the advertising world and the technology world that I was selling marketing solutions with, there were 3 markets: New York, LA, Chicago, and then maybe Atlanta, Dallas, San Fran. I couldn't live in any of those and be a single dad in Denver. Mm-hmm. So I ended up deciding I was going to flip houses for a living in Denver. Got my real estate license, went digging into the market and realized that doing a flip was an awful lot of work for very little reward and a great deal of risk. So I actually never did a flip because it was going to cost me way too much money for a 30% return and a whole lot of risk. So I became a residential agent. I did that for many years. Did not really like being a residential agent. I'm still an agent today. I own my own brokerage. But what the reality is that at one point I was in a seminar, a real estate club in Denver for investors. And I heard somebody talking about multifamily, and I stopped and I sat down. The thing that was fascinating to me was that in my business and sales, it was the same amount of work to sell an advertising schedule for one city as it was to sell it for the entire country, or to customize it for one product or 30 markets. And the speaker I was listening to talked about scale. Hit me like a ton of bricks. Sat down, and literally 1 minute later, I realized that I had spent my entire career working on a scale model. And why was I not doing this with real estate? So I jumped into multifamily syndication. Okay. And several years later, here I am.
Very nice.
What areas you focus on, David, geographically?
Geographically, I've got property in the Southeast and the Midwest. I've been looking in Colorado a lot. There's a challenge there in Colorado because I want to be here. It's my backyard. I know it intimately well. However, the yield is not as strong as it is in some of the other states. I'm looking right now in Texas, like everybody and his brother. I've got property in Alabama. I did a deal in Arkansas. I've got some stuff in Kansas City area. So really, I am in the Midwest, trying to get into the Mountain West in a way that is compelling. What I found is that migration informs my decision making, and there's a lot of migration to those places. Everybody's hearing that. One of the reasons I love Kansas City, it's got a very diverse employment base. It's got a very stable, steady Eddie population. A lot of people may not know this, but Kansas City is one of the biggest test markets in the U.S.
Really? Nice.
Yeah. If you're launching a product, you test it in Kansas City.
Okay.
Why? Because it mirrors the U.S.
Mm-hmm.
And I see the same trends. They've got a lot of different enterprise. They've got a lot of employment base. Cost of living is not sky high like it is in LA or New York or Miami. So that's one of the reasons I'm focusing in that area as well. Mm-hmm. Plus, I went to KU and I know Kansas City.
Yeah.
Yeah.
Is your forte on that? Is it mainly value add or core plus, or what do you look
right
at?
now? I'm doing Class B and Class C value add. I'm not doing new construction, and I'm not doing ground up development because I don't have that skill set.
Mm-hmm.
When I find the partner that has that skill set, I'll investigate it. But until then, I'm doing what I know, and what I know is to bring value to people and value add. While it's a competitive landscape, there's something really beneficial to the community with that. You fix blight, you fix deferred maintenance, you bring to life something that people have beat down, and you give your residents a pride of residence.
Right.
And that's really crucial. You know, people don't talk about that enough, but if you're happy with where you live, a whole lot of other things domino from that, like being happy coming home.
Mm-hmm.
And you can't change everything, but coming home to somewhere that looks better than somewhere that looks trashy always feels more pleasant, I guess is a nice way to say that.
Yeah. It's one of the things we've always said, just because, our residents, this is their home. Their apartment is their home. So we want to give them a good product and make the overall neighborhood and the overall apartment complex better by doing capital expenditures and doing things to improve the community. And, you're right. When people are happier, they take care of things and they refer their friends to, hey, this is a great apartment complex. Why don't you come live next door to me, kind of thing. So yeah, those are all great ideas.
Yeah, there are a whole bunch of dominoes that come off of that, right?
Mm-hmm.
Less crime, more referrals, children perform better in school. And I've got a lot of buildings with a lot of kids in them. And that's important, right? And we all know that our children are our future. And if they are not performing in school and they're not learning and they're not growing, it hurts us as a society in whole.
Yeah.
Something we don't talk about much, but really it's a factor for sure.
Mm-hmm.
That is true. Yeah. So David, if you think back to your advertising days, is there a funny story you can share? Something that happened to you?
There's a lot of stories. People think that it is what advertising is what, I just forgot the name of the show.
Mad Men.
Mad Men is all about. At one point, I apologize, my phone's ringing. At one point, I was a new kid in 1990 somethings, and I went to work with a publisher from the New York Daily News. And he had 3 martinis before we had been served lunch at a restaurant. And he was telling me, he was down talking, belittling me the entire time. And my boss was there, and she was a supporter of Alabama. Roll Tide, and for in honor of you. And he was, belittling me and telling me how much I didn't know. And I was kind of a young kid, and dessert came around, and I think he'd ordered his 4th martini at that point, and I ordered milk and cookies. And my boss thought it was one of the best moves ever, was that the publisher from the New York Daily News was belittling me, and I ordered milk and cookies. So I found that was, a little bit of a jab here and there,
right.
But it's not Mad Men. People think it is, but it's not. And I think that was the only guy I ever had lunch with that had gotten sauce before noon.
Mm-hmm.
And he was a dinosaur at that time.
Mm-hmm.
So, you've got stories, but none of them come to mind right now other than that one. There's another guy who I used to buy advertising for United Airlines.
Uh-huh.
And at this point in time, the newspapers were the fastest way out before the internet. And I would read on the subway in, I would read I'd read 5 newspapers every day to know what my day was going to be like.
Mm-hmm.
And at one point, I was meeting with a publisher from a New York paper, and he asked me where I grew up, and I said I grew up in Tulsa, Oklahoma. And he said to me, "Did you ride a horse to school?" So, the thing I take away from advertising is so many perceptions are out there that are unrealistic.
Yeah.
Mm-hmm.
Yeah. And I made great friends and great coworkers and had some experiences that were amazing, but those are 2 of them.
Yeah. Very cool.
Well, David, what was a deciding factor in getting you to change out of the advertising world into the real estate world? You said some of it had to do with, family dynamics, as you couldn't be travel as much as you were initially, right. 39 weeks out of the year. Was that one of the driving factors? Then obviously you went into different parts of real estate and eventually ended up in the multifamily side of it. Kind of walk us through how your evolution on that thought process was.
Yeah. So great question. Thank you for asking that. When I looked at the landscape, and I'm a sales leader, I lead sales teams for a living, and I help people maximize potential, right? That's what a sales executive does, aside from all the mundane stuff that we deal with. And the reality is that as I looked at the world, what I came to realize was that the world was changing, and the change was tremendous. My previous employers, one of the guys I worked for was a billionaire who founded a company called Westwood One. And we used to broadcast all across the world, syndicated sports programming, and I did all kinds of other stuff. And one of the things they taught us was never cap a salesperson.
Mm-hmm.
And so I was looking for a job where I was used to never being capped. And in corporate America, if you make more than your sales leader or your sales manager or your VP, you're going to have your list cut. You're going to have your territory reassigned. You're going to have some sort of passive aggressive income reduction strategy applied against you. I literally at one point in time sold the biggest contract in the history of our company at that time. And I put in my commission structures. The EVP called me and said, "We can't pay you that much." I'm like, what do you mean? He goes, we can't pay that much. The board will never let us. And I said, well, that's what I earned. So I ended up negotiating my commission after the deal. And so all of this stuff is in my head as I'm looking around. And what I came to realize is that real estate doesn't have a cap. So why is that important? If you're not going to invest in real estate as a general partner like I am, but you're going to be a passive investor, it's equally as important that your real estate investments aren't capped. What I actually want is I want my passive investors to make more money than I do.
Yep.
Kind of mathematically hard to do, but if that alignment is there, that makes sense. So part of my iteration was to look for ways that as a leader or a coach or a person that likes to make people's lives better, I could provide some value that was economic and that was unlimited. And what I found is that in multifamily syndication, self-storage syndication in general, this opportunity was present. And remember, syndication didn't exist until really about 2014 when they changed the Jobs Act. Heretofore, syndication was the purview of the super rich who were only buying 506B opportunities that the consumer didn't know existed. And the only way for this was the quintessential good old boys network.
Yeah.
And one of the things I really was attracted to about this is that it allows us to further distribute economic opportunity to more people.
Yeah.
I don't know if that answers your question or not, or if I went on a tangent, but that's kind of how I got here. And all of that literally hit me real quickly when I was investigating multifamily.
I love that aspect that, again, we do well, but at some point in time, we do well when our investors do well. When they make money, we make money. And that's our first priority, is to make our investors money. And then we come along behind. I actually had it didn't happen to me, but I know of an exact same situation where a software salesperson at an enterprise company, one of the name brands that we all know, made a huge sale. And then they had the same thing happen to them afterward, where they management did everything they could to cut the commission, which is so wrong. And again, so
it's counterintuitive to the world.
It's so demotivating. Again, why would you want to cap? You want those people to continue to sell. If they sell $100 million, pay them for the $100 million they sold, right?
Yeah.
Because the company does well.
I remember one time I was talking to my EVP, and I was a regional VP at the time, and I had a deal that was a 7-figure deal. And in the advertising world and radio, $1 million contract's pretty big deal at the time. And I told my EVP, because he was cutting my commission on that one, I said to him, I'm better off spending that time working with my broker than I am selling this business, because I'll make more money. I might have had a reputation for rocking the boat a smidge in that environment. Yeah. And my EVP was on my side, and he went to the CEO and said that, and the CEO said, tough. And you know what? That contract did not renew.
Yeah. Right.
I found one that was more profitable to me and less time consuming.
Sure. There you go. Exactly.
And that's what sales leadership is about, is making sure that your people are taken care of. It's the same with real estate.
Right.
Exactly the same.
Yeah. Yeah. So David, as you were shifting from doing, maybe it was as you were leaving the W-2 world, corporate world, and going into being a real estate broker, or perhaps it's as you were really shifting into kind of doing more multifamily at scale, like you said. Were there some obstacles you encountered along the way that you can mention?
I mean, there are a ton of them, right? So the obstacle I'm still encountering, and I need help over, is finding the right partner. I have not found in 3 years the right partner to take this where I know it can go. So it's been a lot of assemblage of partnerships that are deal specific. And so that's been a big obstacle. From a executional point of view, the couple obstacles we face right now are that we have inverted leverage. So what that means for the listener is that right now our valuations are producing returns less than the interest rates we're having to pay to borrow money. And that negatively affects our returns, and it negatively affects the yield. And it also makes transacting really difficult because the sellers, we're in an evolving marketplace. Sellers have not yet seen the light, if you will, that the value we had in 2020 is not the same value we have in 2022 or looking forward to 2023. So that's been a big challenge. I think other challenges are learning the industry was not hard, but it's a ton of data points. So having been going at this with partners that are affiliated with the structure based on a project system, you kind of got to learn it all.
Yeah.
And there are little nuances that have been fascinating. Biggest obstacle, I think, has been when you buy an apartment complex, let's say it's worth $50 million. You got to have a partner that has a net worth of $50 million combined. You got to have an aggregate valuation equal to the property size. You then have to have liquidity equal to 10% of that valuation. So if I'm buying a $50 million property and I'm borrowing $40 million, I got to have $4 million in cash. You then have to have the experience to get the note, right? Because Fannie and Freddie and every other bank's going to say, you don't know what you're doing, I won't give you the note. The fact that you've run businesses before successfully and you've got a CV or a resume that says you've been there, done that, know what to do. These industries are very myopic in their transferable skills beliefs. So those have been some of the challenges. Yep. But as a former corporate guy, we all know that there are certain things that are endemic to success: work ethic, a point of view, the ability to enunciate and clearly deliver your thoughts to a team and to a client relation. All these things that you do in corporate America that are transferable, a lot of people don't think they are.
That's right.
So I think those have been the biggest challenges.
Okay.
Yeah. Well, David, as you look back to when you started the real estate side of your more into the multifamily, even, what was your first victory that you can look back to?
My first victory was about a year in. I joined a partnership and we bought a 400 unit building, 2 contiguous apartment complexes. One of them was 100% uninhabited and been vacated and had been condemned to blight. Wow. I was able to go out and raise over $500,000 in the first raise I did. We have 2 years later finished renovating all of that building. We are exiting that property this year. Later this month, I guess, since it is December, I need to, kind of get that out. We're going to do double-digit IRRs. Nice. We hit our 5-year pro forma at the end of year 2. So that's a big success, right? We started out with positive momentum. We do a huge heavy lift, and we are able to exit it in the middle of some really ugly headwinds, not completely at our pro forma. However, at a return that is what? 200% greater than the stock market this year?
Nice.
I can't quite do the math that fast, but the stock market's down, 30%, and we're going to do double-digit positive. So 50 percentage point delta.
That's awesome.
Yeah.
Yeah, right. I mean, people don't think about it. Like some of my partners are like, nothing about this was successful. And I'm like, oh, wait a second. A ton of things about this are successful.
Right.
All right. Yeah.
Yeah, that sounded like it was a huge project. So
yeah.
Well done. Yeah.
And learning from that was probably, we had a construction company that was on the ground, and we had another construction company. And so we had 2 construction companies working parallel, and there was a lot of pressure between the 2, and it didn't end well. And I think that part of this is I learned from several of my operations in the last 18 months that vertical integration is something I'm definitely working toward.
Yeah.
Because no one watches your business like you do.
That's right.
Right.
Yeah. Yeah, I think that's a smart way to go. Ultimately, obviously, you have to be able to afford it, and there's some
you have to get to that scale.
You have to get to that scale, but at the same point in time, that's a very smart way to go. Yeah. So, David, is there a funny story you can share? Something that's happened to you recently?
Funny story. I don't know that I've had a lot of funny stories. I've had a lot of sad stories, and I've had some good stories. Funny. No, funny doesn't come to mind. That in and of itself is kind of sad.
Okay. Now it's
Yeah.
understand. It's definitely
Yeah.
it's a tough market we're in. Yeah.
We're dealing with people's lives,
Yeah.
and people go through hardship. Yeah.
Well, you touched on that a little bit where you kind of your strategic or strategy as you're going forward, but where are you today on your career path and journey, and where do you see yourself going?
Yeah. So right now, Mac Assets is the general partner in 1,000 Doors.
Mm-hmm.
We are working with a couple of private equity companies to create some joint venture opportunities. We are continuing to look for acquisitions to add value in B and C class in the Midwest and in Colorado and New Mexico if we can, and kind of in the mountain and central time zones.
Mm-hmm.
We anticipate doing several acquisitions in 2023. I see positive opportunities. There's going to be a lot of stress in the marketplace. And so one of the things that we're focused on right now is giving investors some education, some opportunity to learn what they need to know to feel comfortable investing alongside us. Mm-hmm. So with that said, we're working really on acquisition and growing our investor pools to maximize investor return.
Yes. That sounds like a great idea.
Yeah. Right. You gotta have it to build it, and you got to build it for them to come, and you've got to show value and educate.
Right.
Yeah. And some of the Midwest markets you mentioned, are you starting to see some price discovery or reallocation of prices from?
Yeah, I got an email today. We made a run at a deal on the plaza in Kansas City earlier this year. Mm-hmm. We walked away from it because they were transacting at about, God, I want to say it was $225,000 to $240,000 a door. I'm talking from memory, so my numbers are not quite accurate. And I got an item today on another value add property that was in Kansas City, and they're trading at they're putting on the market at $150,000 a door. That's a substantial change. Yeah. Now, I think that what's happening may be that the broker's changing strategies. Mm-hmm. Where before they were trying to do a bid they're trying to set the bidding floor. I think now they're trying to set the bidding floor really high to create an expectation and a frothiness, because a lot of plaza opportunities don't arise. And I see what they're doing now is I think they're trying to change the structure for the bidding process downward to get more people engaged. Right. What I'm learning from my people that I'm talking to on the ground is that there's a whole lot of tire kicking and very little execution going on, which is the same thing that we're seeing. Right. Yeah. We see that in the residential side as well. And as long as the Fed I'm really eager to see what the Fed does in the next couple of days. Right. Because that's going to be a kind of a bellwether for Q1. Yeah. And from there, we'll kind of have a little bit of a transactionary vision of what's going to happen. Is it going to be the end of Q1? It's going to be middle of Q2. Is it going to be somewhere in the third quarter? The indicators are that the Fed starts to drop rates about 18 months later. So that says somewhere at the back end of 23, maybe it's a little softer of a set down. I hate to use that phrase, soft landing. Maybe it's less painful landing than it has been in 08 or 92 or 85, or we can keep going down that road, right?
Yeah. Right.
Yeah. So I am seeing some softening in certain places. In Denver, the softening is not quite as aggressive. I haven't seen anywhere near that. And remember that this was a first blush from a property on the plaza. So we don't know where the market will truly go. Mm-hmm. And that's what I'm watching very closely.
Right. Yeah. And again, we all love high prices, but at the same point in time, if you can't do the deal because of the interest rates, well, then it's not going to happen. Plain and simple.
Yeah. The deals aren't footing out because a couple of things. You've got the interest rates are only part of the problem. The other part of the problem is that the bank structure has said, hey, we're not going to give you the same leverage.
Right.
So we're requiring 35% down, which is it's a 15% difference from a 20% down, but that's a 50% difference almost in how much capital you have to bring to the table to have an embedded equity. I mean, there's some real headwinds now to some of this. And so once again, the rich have the capital to play with this, and they can continue to play in those games. And the sales guy who's making a good living has to figure out how to be creative. And that's why I'm here.
That's right.
Yeah. Yeah, we've seen the same thing with agency debt. You've seen some that's priced around 50% these days, where it was easily 75, maybe even 80% a couple years back.
Yeah, and as an investor, a 50% equity is great if you want single digit non-leveraged returns. And as an investor, if you want to be very conservative, that's a way to play it, right? But in reality, investors that are getting their incomes pressured downward from, let's call it the recession that we're going to be in. Yes, we're having some growth, but it's coming. We all see it. There's a tsunami of pain somewhere. We don't know where it's going to hit yet. And we're all kind of trying to put a dart into that forecast. But that investor that has this money that they want to return on doesn't want a single digit return.
Yeah.
And we're not there to provide a single digit return when it's all said and done.
Right.
And if you want a single digit return, you go buy a bond at 4%.
It's your risk
or a T-bill.
Yeah.
Right.
Yeah.
Yep. Absolutely.
Or something, core plus, where it's going to be a very, very low return, but it's going to be a, safe asset, but
yeah. One of the things we're talking about is doing some core plus coupon clippers with some of my joint venture partners for wealth preservation. There's really kind of, if I think about it, there's several different investor types and investor formats, and the wealth preservation guy, I have a bunch of.
Yeah. And
that wealth preservation guy is first, do no harm. Right.
Mm-hmm.
And that's where the coupon clippers come in. And there's a lot of value in that. Like the deal that I'm exiting this month was not a do no value. It was a high risk, high reward.
Yeah.
So I see that the marketplace is really clamoring more to do no harm investments.
Mm-hmm. Yeah. Everybody's scared at this point. So
yeah, some risk aversion is definitely present.
Sure. So David, as you think about perhaps yourself personally, or maybe it's through your company, is there anything you do to give back to help others that you can share?
Well, yeah, I do a lot of things philanthropically, and most of them I keep private, just because it's in my DNA as opposed to my professional life. Mm-hmm. But what I will tell you is that for kids are impactful to me. I've got 2 kids in college and 2 stepkids in college, and I know that the risk of underprivileged, uneducated youth, and so I've spent a lot of energy and effort on working with boys and girls clubs across Denver. I've spent a lot of work on the Boy Scouts of America, helping teach people stuff. Mm-hmm. I do stuff with my church. It kind of depends on what it is. I also, when I can, I love to swing a hammer for Habitat for Humanity.
Okay. Awesome.
I haven't done that very often, and usually I have time to do that in the winter, and then it gets cold, and
Yeah, exactly.
So, well, David, what's something you recently implemented in your business that's allowed you to help scale?
A business coach.
Okay. Yeah.
It's talked about a great deal that as an executive, you kind of know what you're doing. And Malcolm Gladwell writes a long time ago that 10,000 hours creates expertise, right? Mm-hmm. And if you look at, do you have your 10,000 hours in of leading a business? Yes, I do. Do I have 10,000 hours in of working by myself, leading that business with no sounding board and no board or no peers? No. So that business coach has been able to be a lot of that.
Nice.
And I also find that when I talk to other syndicators, I've joined some masterminds, and those have helped me maximize some best practices. Mm-hmm. So some of that stuff's been really good. Working deeply in the automation stuff, hired some virtual assistants offshore. That's been a mixed bag so far. Mm-hmm. The jury's out. Going to continue to work through some of those challenges.
Gotcha.
Yeah. Excellent. Yeah, we've heard. We talk about mentors or coaches. A fair amount on that. You can learn from your mistakes, like you said, or learn from somebody else's mistake, and kind of short circuit some of that. Take some time out of that equation, which always a big fan of.
Yeah, exactly, Bill. Because if you can short circuit that time, you get to improve your hockey stick.
Yep. That's right. Yep. Absolutely. Well said.
And everybody that's in the private equity world or the startup world or the tech world lives for the hockey stick handle.
Mm-hmm. Nice. So, David, what advice would you give somebody who's considering making a path change?
I heard this from somebody else, but one of your guests said earlier when I was listening to some of your other podcasts that desperation is a stinky cologne
Mhm.
I love that. I wrote it down because I'm going to steal it from one ad guy to another. I'm stealing it.
Yeah.
And what I would say is if you're thinking about making a career change, don't plan it out. Be methodical. I will tell you that being an entrepreneur is awesome, and having a paycheck is also awesome.
Mhm.
Until you have the stability to live for a year and a half to 2 years without a dime coming in, don't quit.
Mhm.
Because there have been times when you don't make a paycheck.
Yeah.
And the reality is that we don't talk about that. Someone else in another episode was talking about insurance. You've got to make sure that you have that covered. You've got to make sure that you have the discipline covered. I would highly recommend that you start with passive investing before you jump into full-time real estate investing. I would highly recommend that you go full cycle on a couple passive investing deals.
Mhm.
And this is not to keep people out of the space. It's to make sure you don't go broke.
Yeah.
Residential real estate agents, something like 70% of them fail. And there's another stat that something approximating 30% are behind in their federal income taxes.
Oof.
Think about that.
That's pretty scary.
Yeah. And what's going to happen now is the same thing that happened in 2008 with residential real estate brokers. About 30% of the business disappeared, the real estate agents. There are over 25,000 agents in Colorado. By the end of this downward market, I bet it's down to 15 to 12.
Mm-hmm.
And unless you have the depth to go full cycle, work through it. We've all been there, and we just got to keep working through. And if you have the vision of where you're going, you don't quit till you can sustain.
Yeah, there's a big difference in terms of having that paycheck, weekly, 26 weeks out of the year, whatever it is, with some component of benefits, some component of healthcare payments, and maybe it wasn't as much as you wanted it to be, but it was still something. Big difference from that to you're all on your own.
Yeah, and the mental challenge is tremendous. I don't miss corporate American politics, but I sure miss the people.
Yeah, sure.
Yeah,
absolutely.
Right.
Yeah. Yeah, Bill's great, but I miss some of the people I used to work with.
Right, exactly. Yeah, building these kinds of rapport is fabulous, and it's valuable. And I love the travel that I go to conferences and I learn and I meet like-minded people. But at the same time, if you're going to make the jump, have 2 years of income in your pocket, because making the jump is expensive. There's an output, right? And then there's also a deficit of income for a little while.
Yep.
It might not happen right away, but it'll happen.
Right.
Yeah. That's good advice.
Yeah.
Well, David, what's the best way for our listeners to reach out and learn more about what you and your company are up to?
Hey, thanks for asking me that, Bill. I appreciate it. Macassets.com, MACASSETS.com. I just published an ebook on how ugly apartments deliver beautiful returns. And so if you want to learn what ugly apartments can really do for you as a sales professional, please check it out. Happy to help you out and educate everybody on passive investing within apartment complexes and forced appreciation, what scale can do for you. And it's macassets.com.
Great. We'll provide links below in the show notes on that, David. Well, we really appreciate your time today and enjoyed having you on the Road Less Traveled show. We wish you continued success.
Well, thank you so much. And by the way, just so let you guys know, this is my favorite poem. It's been my North Star poem since I was 17.
Excellent.
We're
still suing Robert Frost for the
That's
name.
Right.
We had it first.
Good luck with that.
That's what I say.
Let me know how that turns out for you, will you?
Exactly. I think he's got a few years on us, right?
Yeah, there's probably some IP there.
Yeah. So, But anyway, so thank you, David, for being on. Really appreciate your time. We'd also like to thank our listeners. Please continue to give us a 5-star rating so we can bring you more great content like our show today with David McIlwaine. And remember, folks, so actually, I'll just tell you real quick, we also want to thank Park Capital Partners that sponsors this show, and remind everybody of two things Park Capital Partners has going on. First, we have the Park Capital Partners Value Add Fund, which is a 506c fund open to accredited investors. And then we have the Park Capital Partners Foundation. It is a 501c3 nonprofit that we created as a way that we give back. The way that works very quickly is that first, Park Capital Partners funds the operations of the foundation. So all the money donated goes to do its best work, and that is to help others. Second, we donate corporately, personally. And then finally, when investors invest with us, we make a donation to honor that investor to a charity of their choice from the list of 15 that we've pre-selected. So please reach out, parkcapitalpartnersllc.com. We'd love to talk with you. And thank you, David, again for being on. Remember, folks, the road less traveled may be calling you. We recommend that you listen and take action. Thanks for joining.